I really like this question, but I don't like this question only when the market is actually down. I like it when it's up. See, we have two emotions that can really derail us from our financial success. One is fear. The market's down. I want to sell everything and get out, right? That's not good to do that. The other part of that is greed. I'm making all the money. I see the stock market up. I want to make all the money possible, which we all do, but we can become greedy, right? And so the goal of investing is to buy low and sell high. So when the news is bad, that's when the market drops. That's actually a good time to look to buy and you find some stocks on sale. And then high is when things are great, everybody's in love with XYZ company or the market overall. This may be a good time to actually take some profits. If I'm able to do this, I can lower my volatility, lower my risk. That's one way to protect yourself. Also, to have investments that are not correlated or equally correlated in the market or to the market. So you hear the term of being diversified and having all your eggs in one basket. But the stock market could be considered one basket. What about having your money in non-correlated assets? Real estate, there's some correlation, but not as much as the overall broad market. And items like whole life insurance and other investments that you can use your dollars effectively and efficiently, even in a down market. So I think looking at the correlation of assets and making sure, just like we've talked about in the past with using tax professionals, you should also, with your investment professional, make sure that they're giving you sound advice to protect you on the downside. And there are many other put options and other things we can talk about that are a little bit more complicated. We can talk about those on another day. But just in general, for everybody to be able to use, looking at and understanding the correlation of the assets you're investing in is going to be key.